Hi, I'm Dan with Pay Down Debt Solutions. Today we're looking at another client scenario, kind of. This is one of my oldest friends. He and his wife, they're retired. So I can't really call him a client because it's a freebie. Not my favorite way to work, but he is my oldest friend. And if you hear me say a little off-color comments, a little weird jokes I don't normally say, or kind of unprofessional, it's because I know he and his wife are going to sit down and watch this video. So I want him to get the full effect. And fortunately, unfortunately, many of you are going to get the full effect too. So let's take a look. She gets her Social Security, $1,910 a month. He gets VA benefits, $3,810. They currently have a $140,000 mortgage at 2%. I've never heard of 2%, and the reason they have that is they did a real mortgage, but they did it through a family member who lent them the money for, I think, where they're currently living. I really honestly don't pay, even though he's my oldest friend, we don't discuss everything. We're that type of guy friends. They've got 18 years to go. They've still got $95,955 in principal and another $18,923 in interest left to pay as they keep paying. But they got that, look at that. Wouldn't you love to have that mortgage payment? $517 a month. Now, just off the top of my head, I told them, like, do the HELOC. 10% isn't what they would get. They're ranging from like 9 to 12, maybe 8.5 to 11 and a half HELOCs. We took them right in the middle of the road. They got pretty good credit. That 10% HELOC, oh my gosh, I did it out of order. They want to do a $125,000 addition on the house. That's what brought all this on. So if they did a 10% HELOC for that $125,000 addition, they'd have it paid off in 30 months and only spend $20,869 in interest. But because they're on fixed income, they are retired, they don't care so much about this. They don't care about how big that interest adds up. Doing just $125,000, this doesn't mean much to them. They're retired. They're not going to be in that house for forever. They're not raising a family like in 30 years. They're thinking maybe 10, maybe 15 years. And because they're on fixed income, their retirement, them enjoying themselves, because as soon as they retire, they got an RV, and now they're traveling, is all about their cash flow. That's all they care about. They need the lowest cash flow possible. They can live with these big interest payments no matter how they finance it. So that's why you see me, I put them up there informational purposes. If they took a 30-year or a 15-year mortgage on the $125,000, or if they took the $125,000 for the addition and they took the remaining principal and combined it for $220,955, the 30-year and 15-year mortgage. But what the important thing is this number to them. What's that monthly payment going to look like? Right? So we'll look up, I'm going to cut away, we'll snap right back, and you'll see me set up the pay down strategy. And I'll give you some numbers we have right now. Their available income, their total income up here, $5,720, minus that $517 payment, because the family member, it is cash only. And that gives them total available income of $5,203. Their living expenses are quite low, $1,500, because they're chill. Even in the summer, they drive somewhere, so they spend the gas go there, but they don't live extravagantly. They live comfortably. So these two numbers are what we're going to plug in. I'll step back for a second so you guys can make sure you take it all in, so I'm not blocking it at any given moment. You can always pause it and double check it. These, as of yesterday, were the national average for 30-year fixed and 15-year fixed in the United States for mortgages. And we say always align, never alone. And I expect that to be doubly true here because they're worried about their cash flow, because that's how they get to enjoy themselves in their retirement. And we'll be right back. All right, we're back. We're looking at this non-client, non-paying scenario because he's my oldest friend. And unfortunately, they're going to like these numbers, which means next summer, my weekends will be spent building an addition on a house, which I've been doing since I was a kid. But every year I get older, the less I enjoy lifting walls. But let's get into it. So their proposed addition is $125,000. We're looking at a 10% HELOC. That's kind of a middle of the road interest. They've got good credit, but they haven't looked into it yet. Credit's anywhere from 8 something to roughly 12, maybe a little under 12. So I just picked a nice easy number, 10%, to do the example for you guys. It's an example for you guys. For them, they're really going to use these numbers. They really want this addition. And I left out, I already built them a house once already. I was there, not every day, but I was there for the bad parts, like lifting 2x6 16-foot walls. They're getting older. They're on the second floor. They've got the drive-in garage and like sporty areas and utility areas in the first floor. They're getting tired of the stairs, especially a dog or cats have to go in and out. You gotta go up and down the stairs. So they're gonna put a single story addition on, make that like a guest room or a playroom for the grandkids. Oh God, I can't believe I'm gonna be lifting walls and putting trusses up again. Anyway, so here's their initial balance at $125,000. They put their available income. You remember that was the Social Security, the VA benefits minus their awesome loan through a mortgage, I should say, home loan through a mortgage family. I didn't write any of those numbers down, but it was 2%, $517 a month. That takes us down to that new balance right at the beginning. We take these two, we add them together, right? Then we divide by 2 to get the average. We multiply that by the 10% rate because it's simple interest. Simple interest is the 10% for the whole year. No compounding interest, right? We take that, multiply that, divide by 12. That gives us this number right here. This is the interest for that month. $1,500 is their average monthly expenses. And it takes the balance down. You can see I already wrote a line under it, $122,316. You can see how fast it gets paid down using the pay down strategy, velocity banking. And this is the same numbers all over again. This number goes here, so you'd start the new month the same way. So I'm not going to show you 39 months worth of calculations. I don't even do them anymore. I created a debt eliminator tool with some programming that spits these numbers out for me. And so we're going to go through 39 months. So we're going to look at the last month. Once all your questions like, wait, you still have a balance. Why do you say it's paid off? So let's look. The 39th month, we start 5,610. The reason it's going to end after this month is kind of in these two numbers and that final number. So you can see here the available income is still less. So there'll be a little bit of interest calculated, right? Because the average. So we take the available income, we subtract it, gives us this 407. Again, we add these together and divide by 2 to get the average for the month. So what is that real fast? I'll just do it for you guys. $6,017, right? We got to divide that by 2, right? So we'll call that 3,000. We'll make it easy, 3,009. Right, so that gives us the average for the month. We're looking at that 10%, so you multiply that by 0.1. It's easy, you just move the decimal place 1. So that's $300, 9 cents, we'll say 301. Divide 300 by 12, and you're gonna come right out here with that $25. That's the interest in that final month, right? That's where we added their monthly expenses back in. And now here's why, even though it shows a balance, we say it's paid off in the 39th month. Because this new balance is less than their income. They no longer even have to put their total income on, and they won't have any interest. They're going to pay this right on the first day. So they're not going to have to worry about any small little amount of residual interest. It's going to be completely less than their available income. So after 39 months, it's done. It's paid off. And you can see how fast they did it. 39 months, a total of $21,349. And you'll notice these numbers were different than I had written down here. I can't remember if I mentioned it or not. But I made a small mistake when I was entering the numbers into the calculator. I juxtaposed 2 of the numbers. It was 38 months, $20,869. It's actually 39 months, $21,349. You can see there's no comparison. Using the paydown method, them using the HELOC, which essentially will be a first lien on their home because their original mortgage is through a family member, so it's not on their credit rating or anything like that. They don't have to worry about any of that stuff. Well, look how fast it gets paid down. And the key is they don't lose their cash flow. They're still spending the same amount every month, and they still have extra left over. Because I think it's 2 days a week she watches grandkids. I can't remember if it's the same grandkids or separate grandkids. She gets to watch them twice a week, so she doesn't just sit there and let them play with old toys. They go out and do stuff. They go shopping. All kinds of fun grandma stuff. And of course, my buddy Grandpa, he's constantly taking them on adventures too. So that's why they need the cash flow, not just for their enjoyment, for them to enjoy their family and their retirement. But look at the difference. Had they combined the $125,000 plus the remaining principal on that original family mortgage of $95,000? Yeah, $95,955. So if they combined that into the $220,000, The 15-year, they'd have been looking at 1,911. If they did the 30-year, 1,539. Currently, all they got is 517. That's a hell of a difference. If they did 2, they kept their original at 517, and say they just did a 15 or a 30-year, depending on their preference on the 125,000, it's not much different. It's better, sure. If you're going down to the penny and we're trying to get them out of debt or something, that'd be a big deal. $200 to $400, that's a lot of money, especially when you're looking at monthly cash flow and trying to build it up. Look, excuse me, like I said, they don't care about the interest. They're not trying to save that big long interest because they're looking forward. They're looking just right now, right in retirement. They need that cash flow to enjoy everything every month. Ooh. And this example doesn't exactly speak for itself. It just gives you a new way of understanding how this helps you. You don't have to be in debt. You don't have to be strapped for cash. You can have plenty of cash flow. You can retire. They have, I don't know the exact number anymore. You told me once years ago. They have a massive amount of savings, but that savings they will not part with. That's their retirement. They're too afraid to take $125,000. I say massive. That's relative. They don't want to take $125,000 out and just be done with it because they're too afraid of, hey, what if something happens? We want to sell the house. We decide to move to Florida. The housing market's down. Now all of a sudden they can't count on that money they thought they're going to get a return on. They like that money in the bank comfort, so they want to maximize their cash flow in their retirement to keep their savings saved, essentially. Saved until they really need it or until they would normally take money out to pay their bills throughout their retirement. Now, I don't know how many times Jen has said it. I say it at the end of the video, always aligned, never alone. And we do these videos to inform you guys and to try to help yourselves, teach you how to use this system so you can think of yourself as a bank, start saving money, start building your own wealth. But that comes with I gotta give you a bit of a PSA. For your sake, for your friend's sake, for him, start discussing. You see this video? If you try it, it helps you, or you think it could help you, whether you do it or not, start discussing with your friends. We've got a friend we've had for 20 years, and we've got another friend we've had for 1 year. Both of them fell into the debt consolidation loan. And what they don't always tell you, how do I want to say this? What they don't tell you is they have to tank your credit in order to help you. Mortgage, credit card, loans, if you're making your payments, they don't negotiate. You have to stop paying. And what happens is, maybe it's just, I only got these, I've heard numerous examples. These are only 2 firsthand I know. I know these people, I've seen the paperwork, I've gone over this stuff with them. They didn't even know what we were doing. They didn't know what we've been doing for over a year. Because maybe we should, but we don't market to our friends. Like we just have conversations. Who wants to talk about work when you're hanging out with your friends? Anyway, and it comes down, the woman we've known 1 year, she had no idea that's how it worked. She did not know until she got a knock on her door and she was served. Her Discover card was suing her for her balance. The debt consolidation company stopped paying all her bills. So then once she stopped paying, then they could negotiate. They weren't even able to save her any money. They tanked her credit. That's automatic because they stopped paying all her bills. Then when they negotiated, they couldn't actually save her any money. So not only does she have to pay all the money anyway, her credit's tanked, she has to pay them a fee for the work they did. And the woman we've known for, it's just coincidentally women, that's just luck of the draw at this point. The other woman, her husband, they did, we've known them 20 years now. This year's 20 years. And they went through the same thing. They had no idea. They thought, they're experts in negotiating. They're going to call and be like, hey, this person is going to stop paying. Can we do this? And you don't need it. Look at it this way. You hire a debt consolidation company for that loan. They're going to tank your credit. They're going to negotiate your rates down, and then you're going to pay them a fee. You on your own can stop paying your debts, tank your credit, try to negotiate it down, and without having to pay someone a fee. Do your own research. Don't just look at whether both of these people, the research they did was they looked at, were these real legitimate companies? Did they have ratings? Did they, it's not just a fly by night, or it wasn't a scam. They didn't look into what's the actual nuts and bolts of what they're going to do. And once you start looking, It doesn't even take much. 1 or 2, maybe 3 searches. I don't know about Google, but some of the other ones, like DuckDuckGo or something like that, you're going to see a litany of people. And it won't necessarily be on a website. It'll be like a Reddit or an Instagram. You'll see a conversation thread of people discussing the actual details of what happened to them. Look at that, and you'll get a better personal understanding. Not just, hey, there's this guy on, Rumble or this guy on YouTube who says, oh, always aligned, never alone. You'll see why I say always aligned, never alone. Tell your friends, tell your family. We enjoy doing this. I love numbers. Jen and I both, we absolutely get a kick out of that. We could make a living helping some people, really helping them. And I don't mean donating money. I don't mean volunteering in a soup kitchen. Those are phenomenal. We do both of those things. We help anyone we can. But the thing I love is I have a person sitting in front of me, whether real or like say in a Zoom meeting, and I can actually help them. I can see them getting happier. I can see them helping fix each other. That is my absolute favorite thing. So even though I'm going to be building walls next year, I'm going to spend my summer weekends building a big addition for a friend of mine. And it's not going to be easy. And it's Michigan, so it's going to be humid and hot. I'm going to be more than happy to. It's fun for me to help. And you can't tell from this. If you ever see Jen standing next to me, she's about average size. I'm not. I'm 6'9", 275 pounds. So if I just sat home on a couch, if nothing else, it'd be a waste of my size. I'm really good at lifting walls up and doing ceilings, because when I put my hand up, that's the 8-foot ceiling. But this isn't about me. This is about helping you guys. I just thought you'd get a kick out of that. As much as I love helping, I don't like lifting walls. It's never fun. It's backbreaking. But we're going to wrap this up. I'm Dan with Pay Down Debt Solutions. And remember, always aligned, never alone. Look it up and find out for yourself why I say that every video. Thank you very much.